If you want to become a tax-free millionaire in retirement, the mighty Roth IRA is a vehicle that can get you there. But you might be disappointed to learn that you're not eligible to make direct contribution to Roth IRA because you make too much money. The income limit for 2024 is $161,000 for a single person or $240,000 for combined household income. Lucky for you, there's a tax loophole called the Backdoor Roth IRA. The strategy is 100% legal and it allows you to fund your Roth IRA regardless of your income level. In this video, we will talk about how the Backdoor Roth IRA works and show you step by step how I set it up. I will also share some of the pitfalls to avoid. Let's jump in. A Roth IRA allows you to contribute after-tax dollars. When it's time to take that money out of the account after the age of 59 and a half, all the earnings, including interest and capital gains, are completely tax-free. In 2024, you can contribute up to $7,000 a year if you're under the age of 50 or $8,000 for those 50 and older. A problem occurs for high-income earners when you start earning above the income limitation. For a single filer in 2024, phase-out range where you can make a smaller contribution starts at $146,000 up to $161,000. And for married couple filing jointly, it starts at $230,000 up to $240,000. On the other hand, traditional IRA does not impose any income limitation for participation. And because IRS allows funds to convert from traditional IRA to Roth IRA, the Backdoor Roth IRA strategy has become a great option for those whose income falls in the phase-out range and beyond. Backdoor Roth IRA is a simple 3-step process. Step number 1, open a traditional IRA account if you don't already have one. From the Charles Schwab page, go to Account, select Retirement, and click on Traditional IRA. Go through the process and provide all the necessary information. Then connect your bank account to transfer funds. Once the account is set up, you can then make an after-tax contribution. Go to Move Money, select Transfers and Payments, then Online Transfer. Select Cash Only and select your linked bank account from the drop-down menu where funds will be transferred from. Next, select Traditional IRA account from the drop-down menu. Select the year, and here we will choose 2024 and $7,000 for the 2024 contribution limit. Frequency is 1 time. And select your transfer date. Then continue and review all the information, then hit Submit. It may take a few days to a week for the funds to be available in your traditional IRA account. Step number 2, open a Roth IRA account with the same brokerage if you don't already have one. Transfer the $7,000 from the traditional IRA account to the Roth IRA account. I usually make the transfer within a month. And make sure that both your Roth IRA and traditional IRA are linked under the same access so you can easily transfer funds between the two. Go back to Move Money, select Transfers and Payments, then Online Transfer. Select Cash Only from the traditional IRA account to Roth IRA account. From here, you will be prompted to fill out a Roth conversion request. Again, from traditional IRA to Roth IRA. Under conversion type, select Full Conversion if you have exactly $7,000 in your traditional IRA, or Partial Conversion if you have remaining balance in your traditional IRA account. Here, I will select Partial Conversion and enter $7,000. Next, you will need to enter tax withholding information. The default setting is 10% withholding for federal income tax and 1% for state income tax. Change both to no withholdings. The reason for electing for no tax withholding is because the Backdoor IRA conversion is not a taxable event if you have no other money in the traditional IRA account. Also, because the money in there was already after-tax contribution. Next, verify that all the information is correct. Select I agree and submit. And that's it, easy peasy. Once the money is in your Roth IRA account, you can start investing. I would recommend buying ETFs such as QQQ or SPY. Step number 3, make sure you file the IRS Form 8606 with your 1040 every year you do this backdoor conversion. There are some common pitfalls to look out for when doing the Roth IRA conversion. Number 1, avoid trickle-in contributions. It's common practice for most people to automate their savings, but this can create a lot of headaches or even tax consequences to convert small transactions every month. When it comes to backdoor Roth IRA conversion, it's best to do it on a lump sum basis once a year. Number 2, the pro rata rule. Example that I showed earlier assumes that you don't have any balances in any of your traditional IRA or SEP IRA. But if you already have balances in any of these accounts, then this will trigger the pro rata rule and make the backdoor Roth IRA a bit more complicated. The pro rata rule is used to determine how tax-deferred money should be taxed upon withdrawal or transfer. For example, if you have a traditional IRA for a few years and it's currently worth $93,000, now you learn about the backdoor Roth IRA and you want to participate. You contribute $7,000 for the year and want to make a Roth IRA conversion on the $7,000. Unfortunately, part of it is subject to income taxes because only the pro rata shares of non-deductible IRA assets would be considered a tax-free Roth conversion. The $7,000 deposit brings the account balance to $100,000. And because the $7,000 conversion is 7% of the total account balance, in this case, only 7% of the conversion would be tax-free. So instead of a properly executed backdoor Roth IRA conversion, only $490 would be converted without taxes. You owe ordinary income taxes on the remaining $6,510. This defeats the purpose and it's not the result you're looking for. There's some workarounds where you might be able to roll your traditional IRA into your employer's 401k, but the rules are more complicated. Be sure to consult a professional. Number 3, forget to file Form 8606. You must file Form 8606 for every year when you contribute after-tax money to your traditional IRA. Conversions from traditional to Roth must be reported. If you fail to file this form, you will be taxed on the distribution of your non-deductible contributions, which defeats the purpose of the Roth IRA. If you are a high-income earner, take advantage of this process and invest in a Roth IRA. If you'd like to learn more about the different types of tax-advantaged retirement accounts, check out my video here where I explained the different retirement accounts. Don't forget to like and subscribe, it really helps out the channel. See you in the next video.